Memo to Cathie Wood, close your fund. Close it. Listen to what the late Jack Bogle would say. Close it.
That investors have pulled a net $2.7 billion from the funds since the end of June.
ARK Invest Cathie Wood is on the defense.
I actually feel a little more comfortable. I like bad news.
Over the past few months, criticism against Cathie Wood has garnered substantial attention. However, Cathie Wood recently went on CNBC to dispel any attacks against her. Not only that, but she also boldly warned of the most unanticipated crash in history. Nobody sees what she believes is coming, and this will lead major institutions and investors to suddenly lose billions. This video will go in depth on the massive catalysts that are coming and how they will heavily impact the stock market going forward. Short sellers are rapidly attacking Cathie Wood's funds. They've shorted almost all of the holdings in her funds, and some have shorted her entire innovation ETF. In fact, one management company is about to launch an ETF that exclusively shorts ARKK, or ARK's Innovation Fund. So why are so many short sellers like Michael Burry confident in their positions against ARK? In short, these short sellers think massive inflation is coming soon. Not only that, but investors worldwide have witnessed stocks rise substantially over the past 12 months, which could lead to a fatal crash. A surface level analysis would show us that consumer prices are rising, and therefore, this overheating will lead to a major crash ahead. However, this has become a popular opinion lately. When everyone thinks a crash is going to occur, that's when a crash is least likely to occur. Cathie Wood does think that a crash is coming, but not in the way that you might imagine. Many renowned investors believe that the risk of overheated inflation is incredibly high. However, Cathie believes a completely different risk is imminent: deflation. This might seem totally crazy, especially since the Federal Reserve has printed immense amounts of money. Nevertheless, Cathie's bet on the ultimate shocker of deflation starts to make more sense after a deeper dive.
I actually think it's more of a macro call. When I read the bearish analyses, they seem to be centered on inflation and interest rates going higher, which will kill valuations. And if anything, as you mentioned, Carl, we're focused on the deflationary forces that are building up in the economy. I think that's going to be the shocker out there, that deflation is the greater risk now, not inflation.
There are 3 deflationary forces that will inevitably take place. But before we get into that, we must talk about the several sectors that are about to die off. The movement towards new technologies has been vastly accelerated by the pandemic. Electric vehicle sales have increased substantially during the pandemic, especially in comparison to fossil fuel powered vehicles. The pandemic has caused many people to realize that electric vehicles are superior to gas powered vehicles. That might sound like nonsense, but the data that has been coming out recently is mind-blowing. In the UK, plug-in hybrid sales are up 93.6% in 2021. Additionally, electric and hybrid electric vehicles are experiencing a similar increase year over year. On the other hand, petrol and diesel are being demolished, with diesel down an astounding 46.9% year over year. Online retail is also experiencing a massive acceleration in sales. The world is not going to go back to outdated services. All these quote-unquote recovery services are recovering, but only in the short term. Over the long term, these stocks will fall 90% or even 100%, as many of them inevitably lose market share. This is not a small-scale event either. The transition to new technologies is going to affect at least half of the S&P 500.
When we look at the S&P 500, for example, we think that because of technology changes, a lot of industries are in harm's way. Energy certainly is, because of electric vehicles and the move towards autonomous electric. And you can throw in autos and the auto supply chain. They're scrambling to try and get into this new world. It's going to be very difficult. Even when you think of retail, many investors, I'm sure, think, okay, well, we've seen the destruction there. We think it's just begun in a way, because online retail sales have only hit 20% of total sales here in the United States. When a trend moves from 10 through 20%, it's usually moving into overdrive. So we think a much higher percentage of sales will be online. So even retail and any business that can be done online. Financial services, I would say digital wallets, DeFi, a big problem, a big challenge for financial services.
There are many outdated sectors that are quickly losing market share and will only continue to lose market share. However, there is something even more important that we have to talk about. There are three main deflationary forces, the first one being technology-enabled cost declines. Over the past decade, demand for electric vehicles worldwide has risen substantially. This increase in demand was primarily driven by the cost decline of batteries. Lithium-ion battery prices have fallen dramatically over the past 3 decades. The economies of scale and technological advancements will guarantee that battery prices will continue to decline over the long term. Now, this isn't just the automotive space. Similar exponential declines are happening in almost every sector. Manufacturing, utilities, agriculture, and transport and warehousing have all seen enormous increases in real productivity. Technological advancements are creating deflation purely through increased efficiency. However, while innovation is a long-term deflationary force, in the short term, it isn't as strong as the last deflationary force out of the three, which we will talk about soon.
Not all deflation is bad. There's really good deflation associated with these technologically enabled platforms. They follow learning curves, which are characterized by declining costs and prices, and enables more and more sectors to have access to these powerful new technologies.
The second source of deflation is another long-term trend. In the first force, we talked about how innovation increases efficiency, which leads to lower prices. On the other side of the spectrum, there are also incumbents who are being disrupted by these new technologies. These incumbents are soon going to be stuck with obsolete inventory and assets over time. For example, the Ford Mach-E is a great step towards electrification. However, Ford now has to compete against its own fossil fuel-powered vehicles. Furthermore, it has to spend time and money transitioning into a newer, unproven territory for them. In other words, Ford is essentially creating competition for itself, which will inevitably drive prices down for its vehicles. Some companies are even worse than Ford, as they aren't even taking on any new technologies. Those are the companies that will certainly be stuck with outdated products that must be sold at a lower price.
The bad deflation is going to be associated with companies who paid too much attention to short-term oriented shareholders who wanted their profits now, wanted their dividends now, and did not want companies to sacrifice short-term profitability in order to capitalize on some of these massive trends that we see building. They are going to be stuck with obsolete products, and yet in the meantime, they've leveraged up their balance sheets to buy back sales and satisfy short-term oriented shareholders. How are they going to service that debt? They're going to have to cut prices of these products and services that are not going to be as popular in the future as they have been in the past.
The two deflationary forces that we covered are both long-term trends. On the other hand, the third force is much more powerful in the short term: commodity prices. A few months ago, Cathie Wood predicted that lumber prices would crash, and lumber prices did indeed collapse. Since mid-May, lumber prices have fallen from over $1,600 per thousand board feet all the way down to under $500. Similar declines have also occurred in other commodities, although they haven't been as fatal as a lumber crash. Copper is down roughly 15% from its highs in mid-May. Additionally, oil has declined by over 15% from its highs. Lumber, copper, oil, and many other commodities have fallen significantly from their highs, leading many to think that the crash is already over. However, Cathie Wood definitely doesn't think that. The commodity crash was spearheaded by cyclical commodity price declines and also by the rise of the dollar. Contrary to expectations of the US dollar facing major inflation ahead, the US dollar has only been rising in comparison to other currencies. One of the reasons why the dollar has been increasing is because of China's worsening economic data, which was caused by the impacts of the Delta variant in China. China's economic shutdown will likely continue to worsen, whereas the US hasn't been shutting down much at all because most people are vaccinated. The bond market predicted that the dollar would rise, and it is still pricing in a further increase ahead. Despite everything that we just talked about, everyone is still predicting that inflation is coming. That's why Cathie thinks that deflation will be the ultimate market mover. Nobody's expecting deflation to come, even though several indicators are pointing towards it.
Third source of deflation, which is really starting to come through now in a noticeable way, started in mid-May when lumber prices broke. We're seeing commodity price deflation. Lumber prices have been cut to less than one third of their peak, 1711 to 500 right now. You've got copper down roughly 15%, 15 to 20%. You now have oil down nearly 15 to 20%. And I think the cream of the crop here, and the reason this may be happening and may accelerate to the downside, is the dollar is going up. And that, of course, might be associated with what's going on in China.
One of the major counter-arguments to Cathie Wood's thesis is that we are in a bubble. This is definitely not the case. Valuations surrounding innovations have declined significantly over the past few months. At the same time, skepticism towards innovation has increased by an immense amount.
You know what, when I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news. The discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, you know, our strategy would have been cheered on, rah, 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 go get them, right? You know, and you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble.
Cathie Wood is clearly taking a contrarian stance compared to the crowd. Not many other analysts are predicting the same trends or cyclical movements that Cathie is. With that being said, let me know what you think about Cathie's prediction in the comment section below. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.